الرحمن الرحيم. أهلا بكم جميعا في هذا اللقاء الذي سيتم فيه مناقشة تقارير التقييم الخاصة في الآلات والمعدات، وأيضا بعض الأخطاء الشائعة. معنا في هذا المساء السيد بول كوجلي من الولايات المتحدة الأمريكية، هو مقيم معتمد من الجمعية الأمريكية للمقيمين، بالإضافة إلى السيد مايك كينون وهو مقيم خبير في فرع الآلات والمعدات. يمكنكم اختيار قناة اللغة الإنجليزية إذا أردتم الاستماع إلى هذه الجلسة باللغة الإنجليزية، أو اختيار قناة اللغة العربية.
Excuse me, gentlemen. I can't hear Basim. If he's the interpreter, it's very, very faint. So if he can turn his volume up, that would be great.
Yes.
Okay. All right.
Okay.
I think we'll be good going forward. Okay.
Okay. Am I good now, Basim? Thank you. Welcome all, gentlemen. We have tonight our Mr. Paul Cogley. He's joining us from the United States. Mr. Paul is a accredited senior appraiser from the American Society of Appraisers. Also, Paul has an extensive experience in working in equipment valuation. He's currently also a course instructor and course developer in the American Society of Appraisers. Also joining us from the UK, Mr. Mike Keenan. Mike has over 40 years of experience in plant and machinery valuation, both in Europe, Middle East, North Africa, and the Asian Pacific regions. Mike is RCS registered valuer, specialized in machinery and business assets. He's also a member of the Australian Property Institute, as well being an active member of the Australian of the AAV Association. Welcome all, gentlemen.
Thank you.
Thank you. Thank you.
Let me start with you, Paul, please. If we can go through the evaluation report, what the valuer need to mention or include in a good evaluation report?
Okay, I would be glad to start and certainly have Mike chime in when he wants to. I think one of the first things that I would say is that when you've prepared a report, it would be good for you to review the report to be sure that you don't have any problems with the report. I think what we found in the reviews of the first candidates were a number of things that would come up in a consistent fashion, that we would see them from one report to the next. So we can discuss those, some of those in detail, but I would start by saying it's important that you review the report. It's important to see that your dates are consistent, that in the report, when you talk about the date of the report, the date of inspection, and the date of valuation, that you are consistent with that throughout the report. I think that it's important to be sure that you've properly determined the intended use of the report and the intended users of the report, and that you work with the client to be sure that you know exactly who the intended users are and what the intended use is. The intended use then leads you to what the proper definition of value is that you should use in your report. And I know there are some questions that were raised that Mike and I will address with respect to definition of value. I think that it's important in the report that you anytime you have a photograph or a description or a layout, that you make reference to that, or that you make reference to the particular line that you're valuing in the report. So if you have a picture of a machine tool, reference that machine tool specifically to the detail in your report, so that the reader of the report can know exactly what it is you are looking at. I think one of the other things that we've come up with as we've looked at the reports are that we didn't always see all of the supporting detail in the spreadsheet that provided the analysis of how the appraiser reached the values. So there were times where we were unsure of what index was being used, or we were unsure of exactly what the asset was. And so with larger assets, sometimes it's important to break those down into the individual components, so that we as a reader of the report can understand what it is that that you are valuing. I think we also in the reports found situations where it was unclear as to the depreciation methodology that was being used. And I think it's important that when you're using the cost approach, which is used quite frequently in the types of valuations we looked at, that you be clear in providing information to the client that explains what you believed the normal useful life of the equipment was, what you believed the effective age or remaining useful life of the equipment was, and the approach that you took to depreciation, so that it's clear to the reader of the report that they understand how you did the work that you did. We also saw in the reports a couple of other things. One, we tended to see a statement that said the values are within, that we believe that the values are within plus or minus 10% of the appraised value. I would encourage appraisers to state a value. This is your opinion of value, and to make a reference of that it falls within the range of plus or minus 10%. That's not really appropriate for the appraisal itself, because the reader then could question, well, is it 10% less or is it 5% more? So your value is your expert opinion of value, and there's no reason to make a statement that it could be plus or minus. At the point you valued the equipment, on the date you valued the equipment, in the condition that you saw, that is your opinion of value. A minor thing that we saw too, but something to mention, is that rounding of results. Many times in the reports we saw valuations of tens of millions of reals that were valued down to the last real. I think both Mike and I would say that none of us are smart enough to be able to value something that precisely. So I think it's important to understand that you should round the values to something that makes sense for the size of the asset, that the value of the asset you're determining. We also, as I mentioned with assets, I think it's important to provide the complete description of what it is that you have valued. That would include manufacturer, model number, serial number, make, and any other pertinent information. And be careful about grouping things together, or if you do group them, be sure to value them as one. Be sure to include the identifying information with respect to the individual components, particularly when you're dealing with something that is a higher value. It's also important to include supporting information. I know in a number of reports that we looked at, there were references to, well, we looked at this website, or we looked at this source, or we looked at this information, but there was no detail provided in the report. So trying as someone who is reading a report, or as an auditor who might be trying to recreate and understand the report, it's impossible to do that if you haven't given specific information. For example, a printout of the information that you found on a particular website, or a dated note from a conversation you had with another source, or a copy of a quotation, or something along those lines. So I think those are some of the keys. Mike, you may have some other things that that we saw in reports that you'd like to include.
Yeah, I think probably the formula and calculations seem to be so different from a lot of cases. This is the Excel spreadsheet that was presented, and I think that's important to, certainly us as appraising the appraiser, to follow their methodology and train of thought. In some cases they went on for probably 56 columns. Hardly impossible just to read those succinctly. And I think you know, that there should be some sort of you know, we've got make, model, serial number, location, value. In fact, in 2 or 3 cases, I saw the same value in 3 different columns under 3 different headings. So that's also confusing as well. May just be for ours. We did ask for the Excel spreadsheet to be presented so we could assess the formulas and what had been used. I also think that the spreadsheet detail reference the Rushton information. I know some of it is wrong. The calculations are wrong. It would have been interesting to see those people, those individuals that used it, which I think many of them did, how they would vary it, because they're supposed to be experts. It's not, you know, these guys are supposed to have a reasonable amount of knowledge on this. So to deviate from the age and the life expectancy, as opposed to what, you know, what Taqiyim sets out is a guideline. It's not necessarily to be set in stone. So, you know, the references to those guidelines can be adapted depending on the situation. And in many situations, the machinery might be outside, the machinery might be inside or closed up. It depends. But it would be interesting to see the valuer's appraisal. What was also missing, as far as I could see, was a condition number or condition quote. Now, that's subjective because it's onto the appraiser to make an assessment. There is a formula to do that, but I'm not going to go into that here. But that should also be come into account too, and especially when using the cost approach. The cost approach and the comparables. What condition are the comparables in? What condition is our subject matter in? So that's you know, several things that need to be considered by the appraiser when he's looking at these items and assets.
Okay, Mike, I'm sorry to interrupt.
Sure. Yeah.
When we talk about the spreadsheets and calculations in the Excel sheet, what data does the valuer or the appraiser need to consider when he visits the site of the machinery equipment in his calculations?
Okay. Yeah, the main thing as it's set out here is make, model, serial number, maybe original purchase cost, date of purchase. That's the criteria that he needs to work from. Then going back to do the research on those particular assets, come up with new cost or used machinery value. So it'll be 2 columns to make the comparable list out of. I think that's important because a lot of them were doing straight line depreciation, where Paul and I and others knew for a fact there is available market evidence. It's not necessarily in KSA. And a lot of cases, the machineries come from Europe and overseas anyway. So, you know, wherever you put it, it's available in the marketplace to see and get proper evidence rather than just show a photograph. If it has to go to a spreadsheet afterwards, then that's all well and good. That was done on 2 or 3 occasions.
Okay, can you give us an example what columns that the valuer should have in his spreadsheet if he's using a cost or market approach?
Okay, well, I guess apart from the other ones that we've mentioned already, make, model, serial number, location, year of manufacture will be another one, and then if it's the cost, what cost was it? What cost is it? Sorry, is it replacement cost? Is it reproduction cost, or is it market value in the marketplace? So basically, it could be 3 columns, which you would have to include into that spreadsheet, and it's then the judgment call of the particular, you know, the individual to work out which is the, I guess, the most appropriate value, and whether in fact there is any market evidence for that type of machinery. In some cases, there may not be. So in which case you would say no market evidence was available, and we've used the cost approach, depreciated from either replacement cost or from reproduction cost. But it needs to go in a comments column at the end of the whole report. But try and keep it from going too far across the page. Otherwise, it's unwieldy, and you know, sometimes it gets confusing both for the valuer and for the readers. You know, on the basis of, you know, how many columns? What are we looking at, guys? You know, it needs to, you know, we need to be clear on this and keep it not simple, but keep it short, so that, you know, that people can understand it rather than going into a flowery commentary and flowery formula achievements. You know, it's not rocket science. It's more appraisal is something that's, you know, you grow up with or you come to appreciate. But there's certainly no rocket science involved in it, and it's fairly easy to, you know, to create a situation where, you know, it's the only thing you're good at. But there's a lot of things that I've seen in the past. As somebody asked me yesterday, what do I value? And there's a heck of a lot that Paul and I have valued. We're not going to go into them now here, but, you know, once you've seen the process, then at least you can say, well, I know the process, and it might come up 20 years later. And I think that's something I got from these guys anyway, that the spreadsheet descriptions need to be better described. Now, there's 2 ways to do that. One is to go back to old records if they're available. If not, to go to a used machinery dealer's website and look at that. And certainly in the case of yellow plant, there's a lot of information that's available, and get the narrative from there. Now, if you're not looking at the machine directly, there's could be a lot of attachments for it. But, you know, if you take the basic description, at least you've got somewhere that is understandable. A number 2 milling machine is different to a number 1, is different to a machining center. So there's all those things that need to be put into the thing rather than just a CNC machine. That's really not good enough from my personal point of view.
Right.
It wouldn't be a failure, but it would certainly be, you know, go back and do it again, because you know, what Paul and I are looking for is the skill set of these people to go forward and trust them to go out and, you know, that if we work with, I mean, we don't want to decry them or denigrate them, but basically if we went out onto a website, to a site inspection, these guys, we would be confident that they would do a particular role for us or with us, and we all know where we would stand in terms of the basis of value, who we were working for, the timing to take it, the time, you know, all that report, basically go from the instruction to the final report, and to review it. I would suggest that some of these guys, many of these guys are senior members of the company, and I would certainly suggest that they, I wouldn't say amount of pride swallowing, but I would suggest that they maybe give it to one of the up and coming junior guys and say, would you be kind enough to read that through and come up with any questions that I could, you know, questions that if you don't think I've answered it, then let me know. I need to look at this. And that would be a great skill start for these young guys as well, because they would probably go through it with a finer tooth comb than maybe Paul and I would. We'd look at the higher level things, but these guys, you know, if it's somebody who's competent, who is starting on the track, let's get them, you know, so that they know what they're looking at and they know how to do it and they know what's involved. Because effectively all the reports, apart from the text, the presentation, if you will, all the reports should be identical in terms of, you know, the exclusions, the inclusions, the assumptions. I know for a fact that one guy, some company in Abu Dhabi, said, we don't use assumptions, you know, put it out, but that's a one-off. Usually, certainly as plant and machinery valuers, you have to use assumptions. One being that the machine that you've looked at on the website is an operating machine. You know, you've seen the one that you're looking at, that's operating, but this one, you don't know what the condition is. So you have to make that assumption that it's operating and it's, you know, it's going to work. Mm-hmm. If it doesn't, then you're looking at scrap value, which is a totally different thing anyway. I think also within the report, every report should contain the exchange rates.
Yes.
Euros, dollars, I don't know, pounds. Let's say three or four at least anyway, that, you know, are relevant to the exercise. Certainly dollars and euros will be the main ones that I would look for. And also if there's something in the report to show increases over a period of time, where those were taken from and how they were analyzed within the scheme of things. You know, and that would then depend on the age of machinery up to particular dates. So you might have machinery that goes back to 1989 and you're looking at a valuation in 2022. So if you kick off at 1989, what's the inflation rate and what has the exchange rate been since that time too? But it's not only the inflation rate, it's the exchange rate too. So that's something, I don't think anybody actually covered those in any sort of wildly exciting detail, but that's something that will probably become, certainly find no accountants. They would probably be more inclined to say, well, okay, where's your exchange rate come from? Where's your, you know, where do you get that information? So you could say, well, I've got it from my bank, or I've got it from, you know, the information supplied by, you know, Saudi Arabian monetary policy, etc. But if there's a copy, and again, Paul said, if there's a copy of that as an attachment, great. That shuts everybody up. You know, it keeps everything clean. And also, if it's going through an audit process, then it saves the client time. The auditor then becomes more confident in the valuation that you presented, because, you know, you've supplied all the information, you've used it to, you know, the best of your ability in analyzing it, it need necessarily, you can be consistently wrong or consistently right. So long as you are consistent, that's the main criteria. And show how you've worked, you know. Again, this thing about 10 plus or minus 10%, no. That will be something that Paul and I would put in the back of our minds if I was analysing a report by somebody else. That's what I would expect to have that's sort of ideal. So, okay, a 20% differential, that's a hell of a lot. But let's give that the benefit of the doubt. But that doesn't go in the report. That stays in there. That stays in our mindset, heart, whatever you want to call it. But don't put that on paper. The other thing that I saw, one reference to a website which said how machines work. That's a definite no-no for me. If you're going to do that, put that in your own personal website. Put your own information. Don't put that on the in the report. Certainly not a report to us, because that makes me question: does the guy really know what he's looking at? The easiest thing is to go through it. But if you've got that in the background, somebody say, "Well, did you see these machines?" Yes, I saw them. And sometimes you might say, "Well, I haven't really got a clue what I know they can do, but I went through it with the engineer." That's a different kettle of fish. If you put down that in the report, then that's going to make somebody who's an astute young accountant sit up and go, "Do they really know what they're looking at?" And I think that's important to make sure those sort of things come out. The other one is the references to Alibaba, which they should basically pick up the jug and leave it, because there's limited information. It mainly comes from China. There's a lot more information that's available. It's just, I guess it's these guys, the information gatherers for these companies, whether it's the individual that's done the valuation or whether it's somebody else, they should really make a point of staying away from those and finding other sources of material, which would help them, because it then goes into a spreadsheet further on down the track, goes into the spreadsheet, which may be further on down the track. Hey, I've seen one of those before. You go to the Alibaba thing. There's so many differentials. There's so many people that can do the same thing for $50,000, and jolly well that it would cost $2 million. So it's really amazing how much these guys, and they pester you as well. I know that from personal experience. They really do pester you for your phone and your email and all that stuff. And it's not just one; it's 4 or 5 companies. So it's really, it becomes a pain, really. So let's get it right. I mean, I'm happy to I'm happy to share, and I have done with Ruka, that depreciation schedule, which is the diminishing balance, which I don't think anybody. I think Paul would agree, and also the other guys that have looked at these reports. Nobody's used reducing balance at all. They've used straight line depreciation. What they haven't done is to add back or add in somewhere along the line a residual value. Basically, if you've got a straight line depreciation, it goes to 0. But then if you say it's got possibly a 3% at the end of its life, or 5 or even 10%, that should be an add back. So that's something that needs to be taken into account with the calculation too. Even if it's that could be on a separate column. That that might be useful, because different things have different. You can't just. I think again we saw somebody recently who put a life down of every 15 years against everything. We know for a fact that some of the things like pumps have a life of maybe 5 to 7 years. Furniture maybe have a life of up to 12 years. But this guy put down 15 for everything. So again, this is a sort of thing that I'd probably like to see I wouldn't say a peer review, but certainly a review of the report before it goes out. It's something I know that probably Paul has done in the past, and I certainly have done for my guys that have worked for me. I've worked with them and say, hey guys, check this out and look at it. It's only fair, because you can become so blinkered, especially if you've got 4 or 5 things on the go. But you know, and these guys are, I think, senior employees of the company or owners of the company, so they've probably got a lot on their plate. So the easiest thing is to say, okay, here you go, you look at that, give me feedback and come back to me the following day. It doesn't take long to do it, but it needs to be done. It should not be a form of insulting or anything else. It's just, look, you've repeated yourself on 5 lines. You've misspelt this, you've done this, you know, you've said this in one place, but I don't understand because you've done it somewhere else. And that, you know, item 10, irrelevant and conflicting statements, is that's very clear. And you know, I don't speak Arabic, unfortunately, but you know, those are sort of things that the Arabic speaker would certainly pick up, or should certainly pick up. Don't try and twist it. Just, you know, if it's one statement, leave it alone, but take all the other stuff out that's not relevant. Don't talk about fair value when you're using market value. Although I did see somebody called fair value valuations, which is different. But you know, if you're talking about cost, don't talk about reproduction or replacement cost. Not in the same paragraph. And I think also the phrases used in what was it? The values. No, it's okay. That's gone. But yeah, reviewing the report and the references, I ended up in 3 or 4 times. I ended up spending time renumbering the pages in the report to suit the review.
Yes.
And I thought at the end of the day, no, I'm not going to do that, because that's not my job. That should be whoever's done it in the first place. So basically, for me, that will be a fail.
Okay.
But anyway, sorry.
Yeah, don't mind. Since we're talking about the calculations, I've seen some valuer get confused when they calculate the scrap value.
Okay.
And is it different when they use the Rushton table?
Well, let's talk about that. Actually, I wanted to go back on that. The Rushton table, as I understand it, makes a couple of assumptions. So the first primary assumption is that everything has a salvage value of 10%. And I think that's part of the point that Mike was trying to make, was as an appraiser, you should be you should do your own evaluation, your own research to determine what you believe that salvage value of the equipment is, or the scrap value. There's a difference in those definitions. You know, salvage value, it says you perhaps can get some value out of the individual components of the equipment. Scrap value says it's only worth its material value, whether it's made of copper or aluminum or steel. But the important thing is you can't take the Rushton table as the truth all the time. There are cases where the 10% residual value might be appropriate. There are certainly cases where it's not. But I think also, more importantly, the comment Mike is making is the way the calculation is done on the Rushton table might not be appropriate in all cases. In other words, you would determine the depreciated value, you would determine your basis for depreciation and then add back a salvage value. So the Rushton table does something that kind of creates a declining balance, but we might look at it a bit differently. Again, I think the Rushton table says that it's 10% of your historical cost, and we might look at it differently as what is it relative to the value you've determined. So there are a couple of different ways to look at that. But I think the important thing, Mustafa, is the appraiser should come up with their own independent opinion of what that salvage value is. They should look at the equipment and come up with their own independent assessment of what the remaining useful life is. They certainly can look to reference tables for normal useful life, but I would also encourage them to reach out to the manufacturers or the engineers for assistance in what the normal useful life might be, and use those in their calculations, not necessarily rely on a table that someone else has developed. Now, if you don't have the information or if you can't get it, certainly then you can use those types of sources. I just would add two quick other points, Mustafa, and I just mentioned one, and that is when you look at a financial statement or looking at a plant and equipment register from your client, it's important. And if you are going to use indexing to do some trending to determine the current reproduction cost, you must be careful to know whether the asset ledger is referring to the cost when the asset when the asset was first manufactured, when it was first built. Sometimes companies will acquire used assets, and so the value that's on the books is even though it was their starting point, it's a used value. We'll call that original cost. But it's if you're going to use trending, it's important to do it from the historical cost, or what the cost was when the asset was first manufactured and put into service there. And then the last thing, just to reiterate what Mike said, in your research, in your spreadsheet, whatever, there is nothing wrong with having some assets that you value on a cost basis and some assets that you value on a comparable sale or market approach or sales comparison approach, whatever you call that approach, and mix and match them. We looked at a number of reports, I think, where both Mike, where we saw that the appraiser, consistently used a cost approach, and we came back and said, well, we know that you could find comparable sales information for this type of asset. Don't be afraid to use that, or develop both your cost and your sales comparison, and then come up with your concluded opinion of value. So those were just some other points that I would re-emphasize.
Also, I've seen that some valuer get confused when they're using the useful life for the equipment of the machine. Some of them go to the تقييم machinery equipment manual to get the life, and some of them, from their experience, some machines are manufactured in some countries that they may not be sure about the real life of the machine. It doesn't have any manuals or any information. So how do the valuer calculate or include the age, the useful life of the machine?
Well, Mike, you want to start with that? I'll jump in and afterwards. Go ahead.
Yeah, I think that probably depends on the condition that the appraiser sees in the first place. So let's take a lathe. It's simple. A lathe that's been used for 45 years, and it has nice shiny slideways. It has, the headstock is turning okay, but nobody has the information. Has been lost. It was made in Russia, or it was made in Poland. The company's no longer in business. Where do you go for the information? Well, that sort of information, you might be lucky and find a serial number. You might also be very, very lucky and find a date, but that's probably a skill set. And if you can read Russian, fantastic, or Polish. But the main thing is to make their own judgment call on it, because that is something that will not be in the Taqeem handbook. And you have to put, and I suppose if you're doing that with a lot of machinery, then instead of putting the life, sorry, the age, you will put estimated age, okay, at the top of it, at the top heading, and make a comment somewhere in the report that the machinery is old, it is operating, there is no information available because we understand, you know, a lot of the machinery is no longer manufactured by virtue of the fact that company is out of business or it's amalgamated, etc. The styles have changed completely. Those are the sort of things that the valuer needs to present to his client to say, this is how we approached it. Obviously, if you're going for replacement costs, the nearest alternative that's still manufactured, that may be made in Taiwan, it may be made in China, but you know, if you know it's a really heavy piece of equipment that was made in Europe some time ago, then you have a cost, then at least you can. But to talk about the lives, I saw a few machines not long ago which were purchased secondhand in a batch, and a lot of them went back to 1948, 1950, and still going. 1948, 1950, 1970, 1980. So I think about 8 machines in this batch. They paid 240,000 dirhams. So, you know, that was tricky just to make an assessment on those. But that was my judgment call. They wanted to know how I had arrived at those figures. I said, experience, my son. That was it. So I wasn't being funny, but, you know, but if you're going to do that, you might find also there may be some on the open market that are still available. So at least you've got some idea of evidence for it. But if you're going for a new replacement, then that might be very tricky indeed. Anyway, sorry.
I think another piece, Mustafa, on that where people may get confused is there are 3 elements that the appraiser needs to think about. One is, what is the normal useful life? How long would this asset normally be used to provide its service? And the second thing then is, in looking at the equipment, making an estimation based upon its condition, environment, etc., of how long it would continue to be able to be used. That is your effective age. And when you know that when you have a normal useful life and you have an effective age, then you can calculate if you use a straight line depreciation methodology, you can calculate the depreciation so that you can calculate the value of the asset. I think where people where appraisers can get confused is, yes, there is a normal useful life table in the Taqiim manual. That comes from a document that was prepared a number of years ago by the ASA, and that's fine. It is a good guideline, but again, I would encourage the appraiser to also reach out to the manufacturer or to the engineers within the manufacturer's company, because you may find that they more currently have a different view. But really, the important thing, if you're taking that approach, is as the appraiser, I think you have to be able to determine the effective age, or the remaining useful life, I should say, excuse me. And I think the example Michael just gave of looking at a group of items that were 40 or 45 years old, probably past their normal useful life, but they still have remaining life left. So what you do is you determine what the effective age is. You don't really ever change the normal useful life, but you calculate the depreciation based on what you think the remaining useful life is, or how many more years they have to operate. So I think I just wanted to make that point. I think that's important.
Yes. Okay, clear.
I think also
yes.
if it comes down to it that a machine has it's in the Taqiim manual, machine has a life of 20 years, an estimated life of 20 years. And it's found that the machine, the actual physical subject machine, is 25 years old. You can't value it to a minus figure. So basically what is assumed, and again, probably should go in the report, where machinery is over it's overseen its life, and we're still more on the minus factor. It should have a remaining life of 1 year. In most instances, the 1 year is explained quite easily, because if it's a priority machine, the board or some senior management would have to order a new one, in which case it would probably take about 12 months to go through that process. Now, if it's shorter than that, we're not talking about small hand tools. This is talking about a major plant item. But, for the purposes of the exercise, unless they get it refurbished, which is a different calculation anyway. But so that's basically what you're looking at. It's still 25 years, but you've got a remaining life of 1 year rather than -5. So it's basically what it would be in straight line. It would be 1/20th of the new cost or reproduction cost. So you wouldn't have a minus figure, but just to make sure that it's noted somewhere in the report in a paragraph that where life, you could note it with rounding, rounding unusual with everything, it's been rounded, and where machinery has exceeded its useful life, we've allowed for a remaining life of 1 year, unless otherwise specified, in which case you put it down in your column notes alongside the comments for each machine. But yeah, that would be anyway. Okay.
Yes, Mike, since we're talking about the age and life,
Yep.
what should the valuer do if the asset has an age less than 1 year, like 3 or 4 months? How he calculate that?
Well, I guess, I've never gone down to that degree, so I've always used a 1 year life rather than if you're looking, it's different if it's a brand new machine. It's gone in, it went in January, so now we're looking at September. So the machine is, 70% through its life of the first year. So basically, then you've got at this point in time, you can say that the age is or remaining life is 19.25, in which way 90.25 by 20 over 20. But if it's that's what I would say, that the life is determined. As Paul said, the discussion with the engineers and somebody who is in charge of the maintenance of the factory, even if it's outside the factory itself, and you find the individual concerned, how often they service the machinery, who does it, etc. That's something that the valuer would need to discuss with within the individual. But the owners may say, we bought this on a special deal. We expect it to last for 25 years. I suppose, I'm not sure how Paul feels about sending reports out for review, but I always do, because there's always something that comes back as the difference, wrong age, or we bought this recently, etc., etc. There's all sorts of things. But if discussion with management goes on before you put, not pen to paper, but before you even send them a draft report, then at least they know and that you've discussed it, rather than you come back and say, oh, I put it down because I thought it's the right thing to do. It would be the right thing to do, but if you've discussed it with them, then you've got your site inspection notes and you've got your discussion notes, which should go combined to go into your report. And if somebody says, how did you arrive at this, then as a document, it's either documented in the Excel spreadsheet or documented in the Word part of your report, under maybe special assumptions or special comments, something along those lines that would be useful, so that they would stand out to the reader rather than hide away in the scheme of things. Yeah,
I would add a thought or two to that. I generally, when I have valued equipment, if I have equipment that as you've described, Mustafa, was just placed into service within the past year, I still would value it based on the fact that I would apply 1 year's depreciation to it, even if it was only 4 months or 6 months. And the argument I make is going back to the rounding argument. None of us are that precise that we can figure out exactly what 3/4 of a year's worth of depreciation is. So I would make it, you know, if it's within the first year, it's a year old. If it's within the 5th year, it's 5 years old, etc. But I think and along with that, it's important to understand a definition of a new asset is an asset that literally has just been placed into service. So like it was placed into service today. And it's not an asset that's 3 months old, 6 months old, a year old is not a new asset. Okay. I hate to say it's relatively new, but it's not new. Once it's been placed in service, it's no longer a new asset. So I think that's a level, again, I think in that first year, that's a level of precision that none of us have. So it's a year old.
Since we're talking about this, we received a question, maybe I shared it with you, gentlemen, about when a valuer evaluates a plant, for example, that has different type of assets, production lines, vehicles, furniture, and etc. Is it possible that the normal useful life and effective age can be adjusted for the whole plant?
I looked at that question, and I would say this: if the question was asking whether or not you could come up with an average normal useful life for all of these assets, I would suggest to you that would not be the appropriate way to do it. There is a huge difference between the useful life for a machining center versus the useful life for a computer, or versus the useful life for a piece of construction equipment. And there are guidelines that you have that you can use for those different lives. Again, referring back to the table in Taqiim or talking to the engineers. So honestly, I think that, and we did, as Mike pointed out, we saw a report where the appraiser used a useful life of 15 years for everything, and we pointed out to the appraiser that really wasn't appropriate. So as a matter of practice, I would not do that. I think it's incumbent upon the appraiser to do the research that's necessary to determine the normal useful life. Now, you may have a group of computers, for example. You may be valuing a company that has 500 computers. So you may conclude something about that group of assets, that 500 computers, not going through and saying, well, this one's 1 year old, 2 year old, 3 year old. But if you're valuing them as a group, that might be appropriate. But I would not look at a plant and equipment register and apply the same useful life to everything in that register. Mike?
Yeah, I think if it was something like let's say a steel rolling mill, you have the process lines, you have the engineering lines, you have the spare parts for the rolling mill, you also have the overhead cranes and the trucks that move stuff around the yard. That stuff takes a big hammering. Therefore, in my view, I think Paul will be the same. Leave the process lines as one life, and put and separate it out for spare parts, tooling, ancillary tools, and vehicles. It makes life easier. At the end of the day, accountants like to play with these things anyway, and they have their own guidelines as well. So we don't want to, you don't want to generate too many problems with accountants. They pay you money sometimes, or they do pay you money. But I think the essence is that if you follow a similar idea. I mean, we looked at I've looked at several processes recently where a lot of it listed as plant and machinery was actually part of a process line, and cranes were looked at as vehicles. So I said, no, that's wrong, and I've changed the spreadsheet, because the client hadn't got a clue about valuation. It was his first valuation he's ever had done. So we said, okay, this is how we should do it. And he was quite happy once that was done. So I think also in our working lives, we have to explain to clients, especially, I suppose, as it's a new part of financial reporting in Saudi, that this is how we would operate. This is what we would do. And I think also I'm sure the financial ramifications of if we adopt this method, or if you adopt that method, that's really going to be a strong talking point, which is where I think the valuer needs to get, or the valuers need to get a full idea of what they're talking about with market value, financial value for financial reporting. Loan security probably doesn't come up too much at the moment, but it probably will, and insurance. So there's at least four ranges of value that need to be discussed with the client. Just to make sure, I had an inquiry the other day and it said, we need a valuation, and it turns out they want a valuation for scrap. They don't want anything else. So that's basically takes the onus out of everything else that we need to do. But there was a comment here, should not refer to the USPAP, which I do agree with. I think that IVS is enough to be going on with. I don't think you need to refer anything to the USPAP. Let's take that out completely. But I think I guess a lot of the questions that you've got, Mustafa, I think probably there should be a comment made within the person's report to say they've either excluded it or included it. So, for example, we've included the rates of or the lives for various groups of assets rather than the whole thing together, which I think was what this guy wanted to know, whether we'd actually do the whole thing in one hit. No, the answer to that is no, because of the nature of what they are and how they're appraised. I mean, I don't know what the plant is, but that's usual run of the mill from my point of view. I'm sure from Paul's and a lot of other guys too, that would say, why have you put, again, we had the 15-year life for the guy who's putting on cars, computers, all sorts of things, which was ridiculous. So, again, even if there's 500 computers, it doesn't matter. They've all got a life of, expected life these days of 3 years, not 5 years. But if they're in good condition and they've got an IT support team, then yes, they probably would have a life of maybe even 6 years. But again, that's something that the valuer would need to go on and see, discuss, and I mean, this thing about valuers being very nosy is very true. We're not property valuers. This is very time consuming potentially as an asset. We don't walk in there with our braces twanging and go, the building's worth 500 million. We have to work hard to find 500 million. And in some cases, we never ever find 500 million. We find, if we're lucky, sometimes we find 5 million. But this is where the skill of the valuer coming in and saying, okay, it's great. Some of these guys that have done these reports have gone into the nth degree about different types of industry within Saudi Arabia, printing industry, etc., which is fantastic. But it's fine. But sometimes the amount of information that's there is probably not relevant. I mean, I suppose if you're going to come up with on a fair value report that you found that the guy next door was also a concrete manufacturer and his plant was sold last year for 20 million, that would be something that would make the accountant's eyes water and grasp you, like you were their long lost brother, because that's the sort of information they want to see. But it's never going to work out like that. We're going to have to split it all down and work it through. But anyway, that's probably a business valuation rather than a machinery valuation. Anyway, there we go.
I have a question. We've received a question. In some cases, when the valuer is inspecting a machine, rather if it has a good maintenance or it has been refurbished, sometimes the age of the machine extend its life. So in this case, how do the valuer consider this in his calculations?
Okay, well, I suppose. Yeah,
go ahead.
Go on, Paul. Sorry.
Well, okay. The way,
Yes,
the way that I would look at that is if you were doing, and I'll use the assumption that you're doing an aged life analysis. So you know what the normal useful life of the asset is. Let's say it's 20 years, and you look at the asset and you know that it's a calendar age is 10 years, but it just has been rebuilt. And so normally, if it had not been rebuilt, you would say it's going to have a 10-year remaining useful life, and you would calculate your depreciation on that basis. However, in the case of if something is not normal maintenance, which is kind of standard, but if it's been rebuilt or refurbished or reconditioned, then what you would do is you would look at what the impact of that is on the remaining useful life of the asset. So you may look and say, all right, this asset by a normal calculation would have a 10-year remaining useful life, but I believe that the rebuild has brought it back to 80% of its original value, so or of its original life. So you would, at that point, you would make an adjustment for that, and you would say it doesn't have a 10-year remaining useful life, but you might say at that point that it has a 16-year remaining useful life at that exact point because it was brought back to 80% of new, and then you would calculate your depreciation off of that.
And you put that comment along the line. We're talking about an Excel spreadsheet now, but you'd put the comment along that line about why you've done that, and especially if there are a group of machines like I've had, and one, because otherwise the values look weird, especially if the oldest machine has the newest life and the highest figure. So that's really why you're putting that. That also should go in the report too, but alongside the asset in the Excel spreadsheet should be a comment there. Why it's been refurbished, either totally refurbished or partially refurbished. And if you can get the cost of refurbishment in terms of invoice copies and things like that, appendices, extra appendices, that's certainly worth what was done to it, how it was done, etc. And also the client can come back and say, well, we've had this done because we believe it's extended its life by 20 years, in which case we basically kick off again, or kick off with 19 rather than 20. Right. So again, those sort of things, you don't want to point accusing fingers, but you can say we've discussed with senior management, on the basis of refurbishment, the detail and level of refurbishment and how it was done and what was done and the expected continuation of life after that. So that's, it's not a get out, but it's certainly something that you show that you've done you've not just put a finger in the air and it's a nice day and they've told me something. It's that all these things have to be documented and put together in the report if possible. If not, you have to document the conversations in some form that management have said to us. You don't need to name names, but it's certainly worth a commentary. Maybe special comments. There should be probably a report in each report should have a special comments paragraph. Even it may not be used, take it out when it's done, but usually these things would have some sort of special comments anyway, and also like exchange rates and etc. But yeah, that's something that would be worth pointing in. All right, next.
Okay. No, I will have this will be the last question about the age. Okay. In some cases, the machinery will be installed in a date And for any reason, like what we've seen, some plants were shut down during the COVID pandemic, it will be shut down for 1 or 2 years. Then it will be start operating later on. So when the valuer should start calculating the age of the machine, will it be from the date of installation or the date from the date of operation?
Well, I mean, I suppose from my point of view, I would start from the date of original installation, because it you know, but again, it depends on what it is, how much in 3 years, how much technology has increased since that time, if it has increased. If it hasn't, then, you know, that's fine. But I'd start it from there. But then I would probably make allowances in the column. But you need to find out whether it's actually operating again, or whether it's going to be operated after you leave. That's the key to it. Because if it's still there, covered in dust and all the rest of it, and the guy says, I'm going to operate it once we get our money, then we'll be back operating. So that's when you come up, and you probably have to play hardball and say, look, you know, I understand, but what I can do is value it now as it stands, and you let me know in 3 months when it's up and going. I will come back and give you a revaluation of that line when it's up and going. But you know, that would be my thinking, because then they in 3 months they should know what they've spent on it, what problems have been eradicated, if any, and you can see physically that it's working. I've done that 3 or 4 times where I've gone back to a client and said, show me what it's like now, and they're quite happy to do that. But yeah, so that's something that's for discussion, I suppose. Sorry, Paul.
I think no, that's great. I think you're spot on with that, Mike. And I do think that COVID, for example, where plants were shut down for a period of time, certainly created an unusual circumstance. However, another circumstance that an appraiser might find is that there is a process line being installed, and it consists, let's say, of 5 major components. Doesn't matter what the process line is, but it could take a year or so to acquire all those assets, put the line together, and have it be functional. So that might be a situation where you would look at that, and if you are valuing the process plant, you know, as a whole, if you will, you might then use the date of commissioning, or the date that the plant actually went into operation. These are unusual circumstances. COVID clearly was. I totally agree with Mike on that. We did have an example, I think, in one of the appraisals that we reviewed, where the equipment had been shut down. It was a process type plant. It had been shut down for 3 years. It had not been started up yet, so there was really no guarantee that all of those components were going to function properly. In that case, I totally agree with Mike. In a case of a new startup or a plant that's new, you may have assets purchased at different points in time, but until the whole process, if you will, is up and running, that's the point at where on a new asset, on a new group of assets, that's where I would start. I would look at depreciation from that date.
Okay. So. Mike, I want to ask you about, we've mentioned rounding the values. Does the valuer need to round the value for each asset, or the total value of the plant, for example?
Well, if he's using the formula anyway, it's rounding each asset. Okay. In other words, it will be line by line. It looks cleaner anyway. But basically, if you're rounding it to 2 decimal places on an Excel spreadsheet, which is easy enough to do, so basically you're coming, the least you will come back with is like 100 reals, you know. So basically 100, and that will be it. But that would be that's the way I would usually do it. But I guess if we say in line with international requirements or international reporting, we've valued it for, we've rounded our figures. Doesn't necessarily, it's obvious anyway, but that's
Right.
something that needs to be said. So yeah.
Okay, let's go back to writing the report, Paul. We've seen some valuers get confused in the dates, the difference between the inspection date, the valuation date, and writing the report date. Also, when in case of inspecting the site or the plant, if it took more than 1 day, what the date that he should consider or mention in the report, Paul?
Well, I'll take a jump at that. I think first of all, I'm going to refer to the date of the report as the date the report is issued. So that's when you've done all your work and you issue the report to the client. And so that's one date that you deal with. The dates that we're talking about that are really relevant in the valuation piece is when did what date or days did you inspect the equipment, and then what is your date of valuation? So if you had a large inspection to do and it took you 2 or 3 days to do the inspection, it's quite appropriate in the report to say that the inspection was conducted between date A and date B. It's not so rigid that you have to say, well, it was done on date B. You can say that it was done between date A and date B. What's really important, and that's important, but you can do that. Obviously, the most important thing is the date of valuation, and that's your date of valuation might be the date that you finish the inspection work. It might be some day shortly thereafter. But what I've seen and what we've talked about in other courses is you need to be careful about that, and you need to state that that valuation date. The best example that people use is, what if you were appraising, and it's not machinery equipment, but the Notre Dame Cathedral in Paris on the day before they had that tragic fire. If you weren't clear on what your valuation date was, you in theory could have a problem with your report because you didn't know that it was going to burn down the next day. And someone might look at it and say, well, your value is entirely inappropriate. It's way too high. This building has been destroyed. No, I appraised it on this date. So that's the effective date of my appraisal, when the building was in good condition. So I hope that helps a bit. But there's the report date. The inspection date can be a series of dates, and then the truly important date is your valuation date. What date did you value the asset? Mike, anything to add to that?
Yeah, I think I did one fairly recently. So I think I had about 9 properties to look at, or nine different locations. So it was by appointment on all of these 9 locations. And I said to the client, what date do you need the valuation? So I think the original point of time was 31st of December 2021. And they then came back and said, no, we'll have it 30th of June 2022. So that's basically a half year or end of year accounting. So that's what we ended up agreeing. The only other issue that I would say would be you don't do a forward valuation. We're not clairvoyant, we're not soothsayers. So in other words, if we were asked to do a valuation now for some time in the future, I wouldn't do it. I would do a valuation now and say, I'll come back in 6 months' time, and you don't know what's going on in the world. So that's really not our concern. If you're going to do that, you'd have a contract to do a revaluation every 6 months, which I know I've done before. But not in the future. You can do a historic valuation, because then you would know that you know, everything you've seen, maybe apart from, I don't know, 5% is still there, it's still operating, etc. But not to go forward.
Right.
That's not a good idea.
Totally agree with that. And if you are asked to do an appraisal at a point in time in history, I believe it's important for the appraiser to indicate in their assumptions that they are making the assumption that if they do the inspection today, but they're asked to value the equipment as of a year ago, you certainly can do that. But that is an assumption that you're making that the equipment was in the same condition a year ago. So you can do that retrospective appraisal, but you certainly should have an assumption in your report that says there's been no change in the condition of the equipment, for example.
Yeah.
Okay.
Okay, good. I've received a question asking about the sensitivity analysis. Mike, some auditors conduct sensitivity analysis to assets valuation.
Right.
So how is it applied to the machinery and equipment?
Sensitivity assessment. Gee, Paul, do you want to kick in? I need to think about that.
Yeah, I thought about this question, and while it's not something I won't claim to be an expert on. I think that auditors will look at other types of assets, financial assets in particular, or financial instruments that are on the books, and they will apply sensitivity analyses to those. If you, for example, if you're a business that has a treasury function and you're engaged in derivatives, okay, as part of your capital, your capital planning, you're using derivatives. I think auditors would look at those derivatives and they would want to do sensitivity analyses to determine whether or not what you've got is appropriate, because there certainly can be a lot of variability. I think if you were doing an appraisal of a plant, let's say a process plant, and you were using the income approach, certainly the auditors could look to that and they could do a sensitivity analysis based on the discount rate that you used in your sensitivity analysis. But that's kind of way beyond the scope of what we talk about here, because most of the times we're not, as machinery equipment appraisers, we're not going to be utilizing the income approach. I think when it comes to equipment assets, I'll call them hard assets, machinery and equipment, the auditors will challenge you for proof of what you did in terms of, well, where did you get this information? How did you use this? What did you do? I've not really encountered a sensitivity analysis beyond those kinds of questions. Mike, I don't know if you've had a different experience.
No, I had the questions and answers and responses, and what you need to do and where you need to send it, etc. But I haven't gone on. I was asked the question: did you not do a financial valuation? No, that's your department, not mine.
Right.
So that's it really. I was looking at the individual assets or the group of assets to put together. Yeah.
Okay. There's one more question about what's the difference in calculations between calculating the market value installed and the market value.
Okay.
Mike.
Market value installed would be the purchase of the equipment, cost of either in-house or external foundations, couplings, services appropriate to that machine or piece of equipment. Let's say a steel mill, you have water, gas, air, what else? Electricity, and foundations and pits and tanks and all sorts of stuff. So that the foundations will be designated foundations from the client, made by the supplier of the machinery to the client, to say, I need these pits built, I need this electrical system, I need this, all these systems put in place before we even set foot in the place. So that's one thing. Now, in a lot of cases, the client may somehow write these things off. They shouldn't be written off. It's all part and parcel of the machinery, and they have to go back, scrubbing back through their records to find out exactly what their on costs would have been. Machinery without these on costs, basically, if you cut it off at the knees and said, okay, we're going to sell this machine, it's going to get out of here. That's basically the machine laid on the floor with no services attached. That's really the in a nutshell what that is all about. But yeah, no services, no nothing. It's just basically the machine itself.
We like in the US, we like to say that an installed value includes any direct or indirect costs associated with making the asset operational. That would be the textbook definition.
Yeah.
Okay. I'm receiving a lot of questions about the usage of Rushton table. I think there's a lot of debate.
Don't use them.
Well, yeah.
Okay. I'd like to hear your opinions, gentlemen.
Well, let me say this, because I was a part of the team that helped develop some of the initial courses, in particular the first two courses, and I know that prior to ASA's involvement, some of that work was done by another appraisal organization, and I would say this: the Rushton tables are one approach to looking at how you might depreciate assets. Also in the text material, I know that there is a table that gives an estimate of the based on the condition of the asset, whether it's excellent, good, fair, poor. There is a table that gives an idea of what the percentage of depreciation might be. And that was developed by an individual named Kirat Budbadi in India. He published it in his text. I know it was incorporated into the Taqeem materials. These should be looked at as guidelines, the same as the ASA table of normal useful lives that was included. They are guidelines, and it's incumbent upon the appraiser to look at those and not just accept them as fact, but rather look at them and see if they are appropriate, any one of those, if they are appropriate for the assets that they are valuing. And that does take experience, but again, as Mike and I pointed out, in the Rushton table, the inherent assumption in the Rushton table is a 10% salvage value. Now, that's appropriate for something maybe that has a 10% salvage value, but certainly not if it's 3% or something else. So I would encourage appraisers to look at the mathematics behind the Rushton table and say, hey, I should make, if I'm going to take this methodology or approach, how would I adjust it? So it's a guide. I view it as a guideline and not mandatory. And I look at the normal useful life table the same way. And I also look at the table of condition of equipment and percent depreciation. All of those the same way. They are simply guidelines.
Yeah, agreed. I think also there's one of the notes in that Rushton table that I've managed to see is it says indemnity value on one line. Now, indemnity value Rushtons are or were primarily dealing insurance valuations, occasional financial valuations, but that's it. Mainly insurance valuations. So the essence of the indemnity valuation is really to, if you haven't got the information, is to basically say, well, indemnity is put you back into the position you were before the fire, before the loss, and this is what it's going to cost given the depreciation rate. So that's really where there's no information practically available for that type of machine. So be careful with it, because there's two lines, and one, if you look carefully, one says indemnity value, the other one I'm not sure, but it does go into it. And in this case, indemnity value is not what we're looking for. I sent you and Ruka a big spreadsheet a few weeks ago, which I hope you can distribute around to all your members. I'm happy for you to do it, because there's two sheets to it. One is the straight line depreciation with a residual value calculation inbuilt, and the other one is basically diminishing balance given the replacement cost or reproduction cost. If you open it up, I don't know whether I sent it to Paul or not, apologies, but you and Ruka have a copy of it.
You can receive it again.
Yeah.
Give it a try, because you'll find that there's a line at the top which says number one, and that number one needs to be filled in with the replacement value. So you choose a life, and then basically it spits down along the column, and then you just pick out the age it is, 10 years or 11 years, whatever, and that's effect. And again, these things are not rounded, so you have to round them, but that goes up to 100 years. So that, if there's any arguments, then that might be the one to do it. It's calculated, it's confirmed, mathematics are okay.
Yeah, I guess the final point I would make, Mustafa, is that a couple of years ago when I went over to Riyadh to teach the courses and I saw the material, that was the first time I had ever heard of or encountered the Russian table. Or the concept of a Russian table. And I had to do a lot of research, try and figure out what it was and where it came from. And frankly, it was not something you could necessarily Google and come up with an answer. So again, anyhow, the appraiser should always use their opinion, and it would be difficult to say to an auditor, for example, or I think even in a court of law, to say, well, I depreciated it using a Russian table. And the follow-up question is going to be, what is that? And what does it mean? And how does it work? And Mike, you did not send me that spreadsheet. That's okay. But if you have a chance and you want to send it, I'd love to get it.
You can resend it again to all of us.
I think it wants to. Yes, I think Mustafa is saying resend it to everybody.
Okay. Yeah, please. It should. Yeah, I think it should be anyway. It's it's useful. There are two pages within the workbook. One is the big diminishing balance, and the other one is basically two pots for showing two lots of cells showing the straight line depreciation with a residual. So choose the residual, put the figures in, and away you go from there. It's fairly straightforward. It's not. It's anyway, worth doing.
Yes, there's one comment which I have seen in some reports, the evidence that the valuer includes in the reports. Sometimes we see website links, layout, also some photos, or some receipts or quotation. Mike, what are the evidence that the valuer should include in his appendix or in the report overall?
Sure. I think the web links are no good. The web links, I have a website in Australia. It's not changed for 4 years. I'm sure Paul's seen websites that have not changed for umpteen years, or alternatively change every week. So when you see it, the day you see it, it should be saved and attached to the research documentation for your valuation. And research is useful because it enables you to print it out again and again if necessary. And if you start a database, then that's one of the things that's helpful. But yes, certainly to have that showing as an appendice. If you can't show that as an appendice, you could put down, I think there were 2 or 3 people that did a good appraisal of 4 or 5 machines, where they were purchased from, the machine model, etc., etc. I know there was one lot of printing machines that had 4 columns, show the ages and everything else. So that was good. It's also useful to find, that's well and good, but if you have something that's actually printed from the agents or the dealers, even so much better, because then it saves. You can do the analysis anyway. That's fine, but print that out too. But don't just show the web link, because the web links can change.
Right.
And as we said already, some of the web links saying how does it work? That's inappropriate. Again, like the Alibaba thing, take that out. You could probably leave in some of the exchange, like eBay. Some of the stuff is actually quite useful because it's fairly live. But the other stuff, like the usual suspects, no, forget it. Leave them alone. There's more information available. It's just really a question of saying, look for it, guys. You can't just take Alibaba as a cut price reliance on it, because you can't. I know for a fact you can't rely on it.
Right. So I totally agree with Mike. I think in some cases, for example, if you're using Ritchie Brothers, who has a worldwide database of information you can access. It's on one hand, it's okay to include that in the report that says I looked at Ritchie Brothers, but that can't be the extent of the information that you provide. And whether it's something that you retain in a working file or something that you include in your report, I think depends upon the client and what you're doing. I would say in the US, we don't always include all of that research in the report. Now, we did expect it as part of what we were doing for our demonstration appraisals, because we wanted to be sure that the Taqeem candidates knew what they were looking at. But I would say it doesn't necessarily have to be in the report, but you need to have that in your working file so that if an auditor comes to you and says, okay, tell me how you did this, you have the information to present. Or if some authority, whether it would be a court or something like that, if you were if they might ask you for your working papers, which would have that detail. So I think it can be individual preference. It probably depends on how many assets you're looking at and how large the report is going to be. But in some cases, I would include it if it was fairly simple. Otherwise, I probably would leave all that detail in my working file. However, I think the point we're emphasizing is you need to have that. You need to have that record that says, on this date, I looked at the Ritchie Brothers website. On this date, I contacted the manufacturer. On this date, I talked to this used equipment dealer. Mike, your thoughts?
I agree. Yeah, because then it's evidence, and certainly when you, in terms of audit and legal matters, that they need to see that there's concrete evidence, being used to appraise the machinery.
Right.
So yes, it's definitely rather than just printing out or copying the website for the individuals. You needn't necessarily, as you said before, you needn't necessarily mention who those websites are, but if you've got an analysis somewhere within your workings, then and somebody says, "Can we see it?" You can say, "Certainly, hands on heart, you can send it off." That's easy. Right. So long as it's neat and tidy and legible, then makes sense, then everyone's happy to receive it and do it. But don't just send off a random selection of websites and say that's what we used. It doesn't work like that.
Okay. Paul, we all know that the value is an opinion of the appraiser or valuer. We've seen that in some reports the valuers mentioned the plus or minus 10%.
Right.
Is it right to use, or when can we use this?
I would, again, we touched on this a little bit before, Mustafa, but I would reiterate that that I would encourage appraisers not to put a plus or minus 10% in their report. As Mike said, when you're looking at something, and maybe as a review appraiser, you're looking at somebody's report, you may have an idea of what the value should be, and if you think the value they concluded is within 10%, you know, you're comfortable with the report they did. But when an appraiser is issuing a report, he is issuing a report providing his opinion of value on that date, on the effective date of the appraisal. So that's all he needs to say. The plus or minus 10%, to me, really is saying, well, I'm not really confident in the value that I'm giving, or something along those lines. And again, if you're challenged on that, somebody might say, well, why weren't you 8% higher? Why weren't you 9% lower? So I would discourage that. Your opinion of value is the value you state in the report, and that's it.
That's a heck of a drop, 20%.
Yes.
You know, 10% either way. No, as Paul said, take it out and basically, it's our opinion. So, you know, we hand on heart. I've said before, you can be consistently right or consistently wrong, so long as you've shown the clear methodology, how you've arrived at those figures, then that's your opinion. Somebody can shoot you down for whatever reason, but you know, that's it. You've stated what you believe given those circumstances. And I think the other thing as well, I think this came across a few times in those reports that we've reviewed, due to circumstances being, I think it was something like we didn't have a lot of time to do the valuation. That's really not an excuse.
Right.
You know, everybody, you know, there's time constraints on these things anyway. And if you have a reasonable amount of staff, then, you know, and the machinery we've seen, there hasn't generally been a huge amount of it. So why it's you know, I mean, somebody got in at the weekend, which is great. But there were two of them, you know, and in 2 or 3 cases where there were more than one person involved in it. So, you know, it should be, you know, I know that, you know, the individual concerned or the individuals concerned, there was only one sign off on it. But yeah, it's interesting. But yeah, okay.
I'm not sure. Yeah, I would have to say I wasn't clear sometimes with that, Mike, whether it was because the students were being, I'll say, encouraged by Taqeem to have their reports ready to do the review, and they didn't feel like they had enough time. Like perhaps Taqeem said, hey, you need this ready next week so we can, or, you know, or to your point, as an appraiser, we need to ask for appropriate time to do the work we need to do. It is not an excuse to say we didn't have enough time. So I give them the benefit of the doubt a little bit with respect to what was done for the reviews that we did, but clearly in real life, in real world, time, that's not, you know, I didn't have enough time isn't a very good excuse. It's not acceptable.
Okay. Overall, if we look at a report, Mike and Paul, when can we say this is a good report? If the valuer did his report and he wants to review his report, or if another reviewer is reviewing a report. In summary, when it can be a good or accepted report.
Okay. I guess covering all showing the understanding to IBS standards, rather than just saying we've referred to IBS standards, but the standard numbers and the literature that goes with the commentary paragraphs that go with those numbers, and what you did, how you did it, and when you did it will be the major thing. There's nothing being on condition in the reports themselves, as in the machinery was seen to be good, etc., etc. That should go in. The spreadsheets, probably most of the spreadsheets were okay, but they need to be, I think, disciplined a bit more into, the amount of columns they're using, because otherwise it gets very, very unwieldy. I know some of them were because we were reviewing them, so that was a different matter. Legible, fonts being the same, format being the same, unless it's an Excel spreadsheet, and the appendices and photographs labeled properly, and table of contents, all that sort of thing. To be, we're professionals. It should be a professional report, and it should come across as that. And really, it's, I guess, if Taqeem have a review of those things, then it should be 1, 2, 3. This is how the report will follow. And I guess really it's the individual company's presentation format that will probably be different. But the IVS standards should be the same, whoever you're looking at in terms of the report, and the commentary and reasoning for doing the valuation calculations should also be, I guess, come into raise its head a bit more than what it was, rather than just, it's for sale, I did market value. It's, somebody's put market value is, and then the full explanation. And so that for me will be a great report. I'm not sure about, maybe the CV and the valuation experience right at the end, or even right at the beginning. I'd probably say right at the beginning, and a summary page of the values right at the beginning too, because then, they can, the client can then wade through the rest of it. But basically, all they want to really see is the numbers, and wants those numbers, and they might say, and their eyes glaze over and they're quite happy, or their eyes widen and say, how did he arrive at this? So that's when the thumbing through the pages goes on. So if you've covered all your bases, then that's really the essence of a good report. Sorry to go on, but that's, it needs to be, and reviewing as well, reviewing for silly spelling mistakes, dates, labeling of photographs and layouts, as we said already, including the evidence in the appendix as well, which is, could be good, could be bad, but, it depends on what it is and how much information. I mean, some of those values, most of the valuations were fairly light in terms of numbers. I mean, I think one was about 50 million. I think the others were about 1 and 1.6 and 1.2 and 6 million. So they weren't huge amounts of numerically, they weren't 600 pages of assets and all this sort of thing. So, it will be easy to do it, or it's easy to do those sort of things, and get the report right, the dates as well, especially the dates.
Right. So I would just add a couple of things quickly. One, I think Mike is absolutely right, and it's good to have a summary page in front of the report that says here's what I did, here's the value. It's good to have the CV or the resume, but it's important that not be a history of the companies you work for and the kinds of work that you did in those companies, but rather as an appraiser, it should be it should show the kind of appraisal work you have done and why you were competent to perform this appraisal. I've done these appraisals for these companies. The other thing I would say is I think Taqeem did an excellent job in the review checklist that you prepared, the checklist against IVS, and I would encourage the appraiser, any appraiser, to go through that IVS checklist every time they prepare a report. I think if you've done that and you've done your research and you've proofread the report and you can answer those IVS questions to the affirmative that were in the checklist, then I think you've got a good report.
Yeah, especially if you've got that checklist at home in your home office, and you've ticked off all those things, and then it's been reviewed, signed off, and all the other stuff that goes with producing a report, then everything's in one place. Yeah. Research done. Yeah. Labeling photographs. Yeah.
All that.
Okay. We have a lot of questions from Taqeem members, which unfortunately I don't think that we can cover them all today. Maybe in the future we're gonna have workshops or webinars that we can cover your questions.
Sure.
By ending this webinar, Paul and Mike, do you have any final thoughts to add?
Well, I would say that if you have a list of questions, Mustafa, I think unless it's 500 questions, Mike and I would be interested in taking a look at the questions, definitely. And I'd be glad to provide a written response that you could disseminate to the folks that were on the webinar. My final comment really to everyone is, well, first of all, thank you, Mustafa, for setting this up. I think it's very useful, and at the end of the day should give the appraisers more confidence in what they're doing. I think that this, in total, what Taqeem is doing to establish a professional organization of appraisers in the Kingdom of Saudi Arabia is tremendous. I totally support the approach that you've taken. It's extremely professional and thorough. I'm certainly glad to be a part of it, in whether it was teaching or now reviewing appraisals. And I wish the best to all of the appraisers and students that are on this call today. This is, I believe, an exciting career, one that's particularly important as the Kingdom of Saudi Arabia goes through the transition in KSA 2030, and I wish everyone well. Mike?
I think it as well, if I've got any information that I'm happy to share with Taqeem anyway, that you can use in the library, like that spreadsheet, and a few other things as well that would be, I think, probably quite useful. Some of them are fairly old, so I'll leave it to you to translate them and bring them up to Arabic or bring them up to they were typed on a electronic typewriter. So anyway, some of them are very relevant to even today, so it doesn't matter. But yeah, so that's some of the things I've got are not only electronic, but they're also quite useful to any member of Taqeem. Plus, I know Paul would probably be, but plus I'm happy to talk to individuals if they want to do a one-on-one or a meeting over a cup of tea or coffee or something as well. So that's probably another thing too in the future. But yes, happy to do that. And good luck to everybody. It needs, that we need to manage it carefully and make sure everybody's up to speed and remains up to speed too, because unlike property appraisals, there's always something changing in machinery. If you specialize too wide, you may lose the thrust, but if it's okay, then that's fine. But you need to keep on top of what you're looking at and when you're looking at it and how it operates. So the website, how it works, is probably a very good reference point for every participant in this, because there's always something that you've not seen or heard about. Keeping up with if there's a technical library in Taqeem for machinery, which can be accessed through membership or through a portal, you know, to a members portal, that would be fantastic. You know, that's the sort of thing that will be very, very useful. And it's, you know, we're not holding things back. It's basically trying to educate everybody to be on the same page. So if Paul looks at it, or I look at it, or Saad looks at it, or Ruka, then we know that, you know, the individuals who've done the valuations have done, you know, have followed the guidelines and followed the steps accordingly. And the other thing as well is, don't be too proud to ask. That's really the main thing. You know, if you don't hide behind, you know, I don't want to do it, I can't do it. There's always somebody that has done these things, and there's always somebody who's more than willing to share the information. As I say, I don't speak Arabic, but hey, translate it into English, and I'll do my best to give you a turnaround, preferably over a cup of mint tea. But anyway, we'll see. But yeah, that's you know, that's definitely you know, something that as you know, I'm coming to Saudi soon anyway, so that's happy. I'm more than happy to come along and have a chat with some of the guys and see what we can sort out and help them.
Yes, yes.
English breakfast this morning.
Okay,
English
Nice.
breakfast,
Yes,
Michael.
yes.
Paul, Mike, thank you, gentlemen, for your time.
Okay.
Also, I want to thank all Taqiyim members who joined us in this webinar for their time. Wish you all the best. Wish to see you all soon in our next webinar or workshop. Thank you all, and have a good day or a good night.
And a thank you
Thank you.
to Basim for his work
Yes.
as well, because I'm sure it was difficult to translate us. Basim, thank you very much for serving as an interpreter.
Thank you all.
Okay. Thank you.
Bye-bye.
Bye.
Bye.
Bye.